anyone who criticises the bank is challenged for criticising the bank's independence or integrity, when what we're actually doing is criticising their competence and their credibility.
When we told you yesterday that inflation was stuck at 8.7%, it was clear almost immediately that that would inevitably mean interest rates would have to rise today. We'll hear at 12 if the Bank of England does put rates up and by how much. But is there anything else that can be done besides whacking mortgage payers to bring inflation down? Let's speak to Gerard Lyons, Chief Economic Strategist at Netwealth. He's in the studio for us today. Good morning to you.
Good morning. It's great to be here.
Thank you very much. What do you expect? Do you mind me asking you this actually? Do you expect it to be a 0.25 percentage point rise or half?
I think the Bank of England will raise rates by 0.5%. I wouldn't rule out that they raise it by 0.25%. I think they need to raise by 0.5%. The reality is the Bank of England has zero credibility. The latest inflation figures have been poor, and because of that, they need to act aggressively. Now, if they had credibility, that is, if they had acted well in the past and if they had communicated properly, then they might today be able to do what the Americans did last week. Last week, the American version of our central bank, the US Federal Reserve, paused on interest rates, but they had a bias to hike. That is, last week, the Americans said, we're keeping rates where they are, but if inflation persists, we'll raise rates again. If we had a credible central bank, they might have been able to do that today, but they're not credible. The last few inflation figures have been poor, so the markets are actually demanding that they act, and therefore they will have to act. As I say, 0.5% is what they should do. It's possible they go a 0.25 point today, and at the August meeting, when they have their quarterly monetary policy report, then they do something again then. But the markets actually think rates will go up today and will continue to rise for some time.
There is a narrative today in the paper, if you look at it, Chancellor's advisors claim that the bank misjudged the crisis. You're clearly in that camp. When should they have acted? Okay. At what point?
Well, okay, the Chancellor's advisors, or many of them, are talking with hindsight. Some of us, myself included, there was a notable caucus of economists, myself included, who a couple of years ago then called for the Bank of England to really act. But in terms of your question, let's go back to February 2021. Inflation was then 0.4%. It was set to rise, and indeed only 2 months later it went above the inflation target. In February 2021, not only was inflation inevitably going to rise, the economy was inevitably going to recover because it was being unlocked. That should have led the Bank of England then to raise interest rates. What they actually did was do the complete opposite. They kept interest rates at 0.1%. All the 9 members of the Monetary Policy Committee then voted to print money, not on a small scale, but on an industrial scale through quantitative easing. And I sit on 2 boards in the city, and firms in the city got a letter from the Bank of England then saying, make sure your systems are capable of having negative interest rates or being able to handle.
Wow.
So not only did the bank not raise rates, they actually gave the impression that they were going to actually do more of the opposite of what they should have done. So they got it badly wrong 2 years ago. They persisted with making mistakes, communicating. But the reality is now it's more of a judgment call. Rates are actually significantly higher. Personally, if they had, in my view, if they had actually acted properly, they could have got away with saying pause today, because the important thing is monetary policy acts with a long and variable lag.
Yeah.
So even though rates have increased significantly, much of that tightening has yet to really impact either people or companies.
Now, I understand that, you look at this in a very kind of cold, hard economics point of view, and we rely on people like you to do that. But is there an argument to say that at that point in 2021, when we'd been through a pretty bad time in terms of COVID and, the economy and shops and, all the rest of it, that there was a kind of, a pressure not to put interest rates up at that point because someone somewhere thought that would harm economic recovery?
Well, it's not just interest rates, it's the quantitative easing. That's really been the big problem. But the quantitative easing conveniently matched exactly the government's increased borrowing.
Right.
So the Bank of England became the biggest buyer of government debts. So the challenge is that anyone who criticises the bank is challenged for criticising the bank's independence or integrity, when what we're actually doing is criticising their competence and their credibility. So, but you're right. When the pandemic hit, more in 2020, no one really should be criticised for their initial reaction to the pandemic. But by 2021, it was clear that it was very different, and therefore they should have acted sooner.
That's the past. Let's talk about the future.
Yeah, of course.
Some of your fellow economists are now arguing that we need to provoke a recession to really fix inflation. In the words of John Major, if it isn't hurting, it isn't working.
Okay, it's important to bear in mind the channels through which monetary policy tightening works. And there's really four of them. One is slowing the rate of monetary growth in the economy. Amazingly, the Bank of England in its quarterly monetary policy report never mentions the word money. Can you believe that? They don't think money matters. Whereas, regardless of whether you're a monetarist or not, it needs to be on your sort of basically list of things to look at. So monetary policy tightening works in four ways. You slow the rate of monetary growth. Second way is you manage expectations, so people become accustomed to low inflation. Third is you get the pound higher to reduce imported inflation costs. But the fourth way is you squeeze the economy, which is the point. I'm not necessarily you do those in order of importance, but there are different ways. But because we are now, as you talked about in the programme earlier today and yesterday, we're now into what's called second round effects. The initial first round effects of inflation were caused by two things: completely incompetent monetary policy and external factors. Now, the external factors are gone: the war in Ukraine, the pandemic. Monetary policy has been tightened, which is why I think we need to be careful about egging the bank on too much now. But we're now into second round effects, which is firms passing on higher costs to raise margins and wage pressures. Now, wages last year did not cause any of the inflation we saw last year.
Right.
So it's a bit difficult to blame the workers now for trying to compensate themselves. But once you're into that second round effect, then this idea is that you squeeze the economy to actually cause the pain, as you said, that John Major, when he was Prime Minister, talked about.
Is it fair to say that Rishi Sunak, does he have to choose between recession and inflation?
Well, one of the many interesting aspects is that the Prime Minister has put lower inflation as part of his sort of variables to watch. One of his five targets.
Yeah.
You can understand that because the general public, if you ask the Prime Minister, would say, look, inflation is the key thing. But for economists, it's down to the Bank of England. So in some respects, the Prime Minister wants to control something that's vitally important, but which is outside his control. Yeah. The bigger challenge for the Prime Minister is now on those two other variables. Of his five variables, he's got the boats, he's got NHS, but three are economics: low inflation, growth, and debt. If the Bank of England pushes rates up too much, then growth will suffer. Yeah. We will fall into recession, and your ratio of debt to GDP goes up, which limits the government's room for manoeuvre, rules out any possibility of tax cuts. So the real issue is on the interest rates. You see, monetary policy works with such a lag. You do need to be careful what you wish for. The need to raise rates today is to restore credibility, and because the last 2 months inflation figures have been poor. The markets think that rates could go up to 6%. If they go up to 6%, there will be a recession. If the bank tries to get on the front foot today and does something at the next meeting, we might be able to get away with rates peaking at 5.25%. Because inflation will start to decelerate later this year. But if rates really go towards 6%, as the markets think, then recession's inevitable. Unemployment rises, companies are hit, no one really gains. Two wrongs do not make a right. The first wrong was actually causing the environment in which inflation took off. The second wrong would be to try and correct that by a deep recession.
I want to ask you about mortgages. I know this is not necessarily your area of expertise, but it's something that people can relate to.
Yes.
Because obviously the mortgage rates are going up, therefore their repayments are going up. Some talk today, well, there's been quite a bit of talk. We spoke to Jake Berry from Conservative MP yesterday, who said that the government need to help people with their mortgages. And Labour are going to say the same thing today. Presumably you don't agree.
Well, it's not just people with their mortgages, it's renters, because the Help to Buy market, in my mind, has led to mortgage rate increases being passed on straight to the renters. The way it needs to be helped is the Chancellor needs to make sure when he talks to the banks, as he said that he will, that there's what's called forbearance. that they actually show some flexibility.
Yeah.
When you start to talk about tax help for mortgage holders, then it becomes very difficult. Look, I've got children who are renting. Not that they would say we should be helped. But the thing is, you need to look at it from everyone's perspective. What you'd need to have is a situation where you do get on top of inflation quickly. Higher taxes don't really help anyone at the end of the day. But coming back to your specific question, whilst it's nice, this idea that you can try and help out targeted groups of people, it doesn't really work in the end. But what they can do, they being the government, is demand of the banks forbearance, that you actually show some flexibility for all those people in difficulty.
Okay, Gerard, thank you very much. Really interesting. That's Gerard Lyons, who's Chief Economic Strategist at Netwealth.